All right, team. So it's going to be a very crucial week. We have the FOMC rate decision on Wednesday, September 17th. And there's a great chance, there's a 85% chance that we're going to have a 25 point basis rate cut. And that is going to greatly help small caps. So rate cuts itself is supposed to help small caps, but given with where the market is currently standing, if you do see the opposite reaction, don't be too startled by it. Don't think that this is not going to happen. When in fact it can be an amazing opportunity. So this is what I wanted to talk about for today's session. Um, but yeah, I hope you all had a great week, team. I've looked at all the charts so far, and the way I see it, some tech stocks could sell off hard in the upcoming session. We can take a look at stocks like Google. And if we notice, Goog is trading in the skies here. It's way too overbought. It needs to digest and let its moving averages catch up, as we can see. And a lot of times when stocks are very, very strong, and they're very overbought from their 20 EMA lines. And I'll show you why I have the 200 SMA line. Very simplified. I use that as my trend gouge, as my trend indicator. So if it's sloping up, to oversimplify it, it means that the market is in an uptrend. And when price action is trading above the 20 EMA line, I use that as a momentum gouge, meaning that bulls maintain the momentum. So as we can see, we're very, very far away from the 20 EMA line. And whenever we do get far away, we need to see price action digest until we eventually get that sneaky retest at the 20 EMA line. And then we shoot back up. So if you do see that heading into FOMC week for FOMC rate decision, that can be a great opportunity for us to buy the dip without really having to be involved in the market. So to put it simply, heading into this week, being decisive is going to be very crucial. We have the FOMC rate decision, so to truly get the best upper hand when rotation does flow out and into other sectors, industries, and assets, you're going to be prepared if you are waiting on the sidelines. So now let's talk about market conditions pre-FOMC and then post-FOMC. It's very, very known when we do go into these events, the market tends to be very choppy. So if you are a short-term trader and you trade options in the short term, whether it be intraday scalp trading, day trading, or short-term swing trading overnight, you're going to have to be very careful because premiums are going to move against you. They're going to move a lot slower. It's going to be very choppy, and these market conditions are not good for you as a short-term trader, especially if you're on the buy side. So if you're one that buys and sells contracts, it may not be good for you because you're not going to get that move to do that sort of transaction. So make sure you do take it easy heading into this week, or at least you take into consideration that it's going to be a choppy week and you're not going to see the trending moves or momentum trades that we usually see when the market is trending. So if we take a look at the S&P 500, for those of us that are part of the mentorship, you guys already know what I'm about to say. We're very far away from the 20 EMA line. We're not really like very, very far. I'm sorry, I shouldn't have said very. We are far away from the 20 EMA line, and it doesn't mean that we can go higher, but any move that you see with us going higher on Monday or Tuesday, expect it to sell off. Expect the FOMC to collect liquidity one way or another, whether it be into the FOMC event, or maybe FOMC event will peak the market and then we will start to sell off. So that's also a great potential to really be aware of. And the beauty of that is you're catching great opportunities on that pullback. So definitely keep that in mind. I think this is going to be a great pivot for the type of rotations that we have been getting into some of these stocks. And if we do see a sneaky sell-off, don't be too startled. Just let it sell off. And it's really crucial that you're not in any positions when that does happen. If you're a short-term trader, don't be expecting the market to really advance beyond means, even if the news is bullish or it seems bullish. Expect the market to pull back, collect liquidity, come down, maybe fill this gap. Worst case scenario, we can expect a pullback down to 640. I think that would be an amazing opportunity for us to buy, expecting wick candles like that to be placed right at that gap fill, or even a retest at this 20 or at this rising uptrend line can be good. So just just really try and be patient. And I think what I should do, I was going to bring the line down here just to be certain, so that if we do see a larger breakdown, this can be the decisive point for us to try and trade the momentum of that breakdown. It aligns with the 20 EMA line, and it also aligns with that recent breakout very well. So any wicks and then regain of it, that would still be within the bullish means. But for now, something that I noticed is that we did break that bearish divergence that we had on the S&P 500. But if I look at the inverse chart here, it still somewhat looks bullish. And keep in mind, team, this is the S&P 500 mirrored, which means when the S&P 500 goes down, this particular chart will go up because it is the opposite of the S&P 500. So um, now, team, before I answer Christopher's question, I do want to say, so if the market has been waiting for rate cuts to come in and a lot of stocks have been going up in anticipation of rate cuts, then why would a rate cut coming in bring that type of bearishness for the market? Well, the logic behind that is the Fed Reserve is pivoting because the economy is weakening, and a lot of institutions out there see that as a weakness. So I did want to bring that up. Um, do you think we get a pullback regardless of the size of the rate cut, 25 to 50, um, before we run up in anticipation of the rate cut? Um, I do want to say that is possible, Christopher, but at the same time, I was going over all of these sectors, and man, there's really nothing that I can think of that can, actually, I'm sorry, there is XLF, the financials, that looks interesting. The stocks are looking interesting, but even then, it scares me that we have this bearish divergence that's still in motion for XLF. So it just, um, there is a lot of mixed signals. To be frank with you, there are mixed signals everywhere that's concerning. And I think for the market to really reset, the best thing is to have a pullback. And the beauty of a pullback is that the stocks that are already weak can pull back furthermore towards their stronger demand levels, right? And then you got stocks that are very overbought, like Google, that's just trading in the skies. You got AVGO absolutely trading in the skies, far away from its 20 EMA line. And then you got other stocks like, what was the other one? Oracle also trading in the skies. They're bound to pull back to their 20 EMA. It's just going to get sucked towards that line like a magnet. And even if they do see any sort of upside, it's very likely going to be unsustained. So this is what I wanted to get across with today's session. I think you being patient going into this week is going to be beneficial. And the reason why is because you're going to position yourself to wait it out, let the whole thing play out, see where rotation flows out of and then flows into, and then you simply react to it. So I think this is great, because if we enter up here, right? If we decide to, let's say, still trade the call side on SPY and whatever other stocks that have been running up a lot, if we trade them, then we risk the potential of getting caught up here during the when momentum gouge was at the highest, and we're not going to have any leverage when we're down to the 20 EMA line, which is sort of the neutral level of whether we do want to enter calls to continue with this bullish market, or if we do break down. So this is what I mean. I think if we decide when we are closer down here somehow, some way, it's going to be much better for us to be in a better position in the overall market. The best part is, if let's say the reaction is very bearish, then we can just let it dry out, let it exhaust wherever it comes down to. And with each of the red session that we will have, we're going to have an even uh, better discounted deals out there. So I think it will be well worth it. Um, there are a lot of liquidity zones. We have 645 here. We have these wicks here that can also behave as a liquidity. And then we got the 618, which is the maximum, not maximum, but the larger support level for the bulls to step in, where demand is uh, going to be very clearly overwhelming, given the recent contacts that we had with the wicks, and then the bear trap operations there. So this is the S&P 500. Let's take a look at QQQ. QQQ is very bullish, don't get me wrong. The setup is really nice, and bulls have been grinding higher and higher, but the candles are getting smaller. Now, um, this particular chart, I have to say, it doesn't look bearish at all. Buyers have been stepping in, as we can see, and even Nvidia, that was causing a lot of that bearishness, is right back up. And the crazy part is, there is so much fuel there. There is so much fuel. The RSI is barely at 55, and it just says, this basically tells us that when we got that sell-off down to 164, that level of support where we established further support, showing that demand, as we can see through the wicks, and rebounded back up, we basically exhausted all of the sell pressure, all of the supply, and now there's not really much supply there. Now, I still do think that we're going to have some fake out, shakeout operations where Nvidia can potentially come down and maybe fill the larger gap there. But if that were to happen, I would probably be a buyer on Nvidia. We'll see. I don't want to decide early on, but I just want to show you that the fuel is there on tech to continue to move higher. So we just took a look at QQQ, right? And if we look at QQQ, which Microsoft is, I think, the second biggest holding, we can see the stock is looking really good here. We rebounded off of that 500 level, that support at 500, and so far here we are sitting above the 20 EMA line. We closed Friday's candle as a nice green session above the 20 EMA line, and just overall showing a lot of strength compared to other stocks. Now, this is a great thing on Microsoft because we are holding calls on it. We're still in the November 21st. We're in this Microsoft call here. Sorry about that, team. So we're in this Microsoft November 21st 560 call at 5:15, and so far the contract is up really, really nice. So if we go to November 21st, we're currently trading at let's see, how much are we up on this trade? Okay, we're up about a nice $60 there. Pretty good. We're up $60, and it is nice to be in that position going into this week, given that Microsoft setup has taken out its supply bar, the fake out breakdown where they trapped the bears. Bulls came in, scooped it back up, and we're at this key resistance level at 510.61. Heading into Monday session, if you see Microsoft showing strength on the intraday above that key level, key resistance level, then our target is going to be this gap fill left over from when we broke down below the 20 EMA line on August 11th at 517.21. So If Microsoft does hold 510.61, we're anticipating that we're going to fill the gap at 517.20, and that would make that contract nicely profitable, where we can get out if the market shows weakness by then. But yeah, so far, this is what I like about the tech side of things. Microsoft, the volume is there. We're just getting above the 50-day average. The RSI, the TTM squeeze, all looking really great. And I think it is possible that we see a nice green session either on Monday or Tuesday for our holding there. Um, Now let's take a look at some other stocks. We looked at Microsoft, we looked at Nvidia. Let's take a look at Apple. Now, Apple does not look too bad. Bulls have regained the 20 EMA line. They filled the gap and they did not sell off. The volume is getting above the usual there, as we can see. Not really getting above the, like, it's not standing out, but at the same time it's just slightly above the 50-day average. So the 50-day average is around 50.8 million volume, and this is slightly higher, around 60 million. So um, personally, I got out of Apple. I sold my contract at 239, but Rain Bond did get back in this one. This is where I got out for my trade with close to 100% profit. Rain Bond did get back in this one. I believe the trade is down slightly. And if this particular sector does see more upside heading into this particular stock within the tech sector does see more upside, then Apple and Microsoft can see upside given their setups. But yeah, if we take a look at the other stocks, team, they're very, very overbought, and I just would not be chasing up here. I would not be chasing AVGO 100%. Very, very overbought, and the chances that this does pull back heading into this upcoming week is extremely likely. The same way that Oracle saw that sell-off, I think it's going to happen on AVGO as well. Now, another stock that's very overbought within the tech sector is Micron Technology, MU. I'm not saying this particular stock is not going to see more upside, but for those of you that do want to see or get a little bit of exposure on the put side, heading into FOMC rate decision, even if it's closing it before the FOMC just to get a nice high probability trade in, then I say if tomorrow you see that MU is up and green, I say buy a put option on it, maybe 1 to 3 months out. And I think you're going to make some nice profits when the stock does have that massive red bar sell-off to get closer to the 20 EMA line. Now, I'm not expecting it to fully pull back to the 20 EMA line, but I can tell you that when we do get very, very overbought from the 20 EMA, we always get that massive, massive red bar. And I'll show you guys an example of SMCI. Let's go back to the old days when this stock was just absolutely ripping. And you can see when we get, so I look at it in the same way that I look at this particular move. You see how we got so overbought on SMCI, and everyone thought that, oh, this was going to just see more upside and rip higher. Well, that did not happen. It did go higher, but it happened after we pulled back to the 20 EMA line. Let the moving averages catch up. As we can see, we got the liquidity around the 20 EMA and then rebounded back up. So all I'm saying with the same thing that happened, and I just noticed another pattern on MU. If we go back to MU, team, the stock is currently up and trading at 159.25 into Sunday's opening session, after hours session. And so far, it's looking like the stock is gapping up the same way that SMCI did at that time when it was very overbought and printed that massive red bar. So, like I said, if you do see something like that and the stock is up tomorrow morning, I think it is worth entering a put option, maybe three months out, to take advantage of that quick pullback, even if it's short lived. So yeah, this is why I wanted to show you this opportunity, and hopefully the example that I showed you with Micron Technology does sort of illustrate why I believe this type of move is expected. So if we go back to MU, this is what we're looking at, and this is happening at a level where we're um, we're at a key supply zone. So at a key supply area, and I think a fake out, shake out operation where we can break out and then sell off is going to be very likely on this particular setup. Um, and yeah, that's about it, team. I really don't have anything else. Like I said, I just wanted to share with the team that heading into this week, we want to be careful. If there were good setups, you guys know that I would share with you. We shared the Baba setup last week, and take a look at Baba just rocketing. This is when we shared on Sunday's meeting at 134, and now it's all the way at 156. We also talked about Baidu and some other stocks. We talked about UNH, and these stocks are all ripping higher, trading at the skies. And like I said, when these opportunities do come to us, I bring it to your awareness immediately. And I want to be frank with you. I went over everything and I couldn't find anything that was good. The only sector that looks good so far to me is XLY, consumer discretionaries. Now, even that particular sector is reaching a potential resistance level, but I think it is possible this particular sector can continue to go higher on Amazon, Tesla, HD, and a lot of these stocks that are getting a lot of rotation with lower rates anticipation. So um, yeah, team. I do have stocks that I think are going to get rotation heading into post FOMC meeting, but I would like us to get closer to the event, react to the event, and then I'll share with the team. But just note that we already, us admins will be on it. Wherever rotation flows into or flows out of, you're going to be up to date. Now, this is KR. KR reported earnings and it's currently trading right at this support level. I think this is one of the stocks that can benefit greatly heading into post rate cut. But we'll come back to this. I'll also confirm heading into this week. We're already holding a call option that's down a little bit, and it does expire in June 2026. So I'm okay with averaging down another contract as I had planned originally. So I'll come back to this particular stock. I just wanted to show you what I was thinking on KR. There are some other stocks, RKLB. This particular one can also greatly benefit uh, from rate cuts. And I'll share a lot more that I think are going to do well. But yeah, team, look at this beautiful setup. Looks really nice, right? IonQ, that's another one. How do I Sorry, give me one moment, team. I am having a brain fart and I forgot to okay, IONQ. It should be IONQ. Am I mistaken, team? IonQ? There we go. Yeah. Sorry about that. There it is. So IonQ, we're holding shares on this stock, and it's starting to break out on this cup and handle. The volume is there. So any digestion that this particular stock sees is going to get absorbed by continuous institutional inflow, and this particular stock can greatly benefit as well. So any stocks like this, you can expect them to get some nice rotation. RGTI. Oh, beautiful. Oh my gosh, man. This is really great. We also have shares. We alerted shares in the stock trade alerts in our Discord. And yeah, this setup looks really, really great, you guys. Also liking this one as well. If you are not positioned into this particular stock or IonQ, I do encourage that you do get in for your long-term accounts, 2 to 5 years out. I think they're going to do really well. And that's really about it, team. I don't want to extend this session any longer. Let's see what our team are up to here. Can you please check UPST? Oh, you know what? Before I look at UPST VA, I just want to say that it's going to be another stock that'll get a lot of rotation inflow after the rate cut. The reason why I say that is because these stocks, the reason why they took such beatings, as we can see over the last 4 years, is because of quantitative easing. So when inflation's high and we get rate cuts, we go into quantitative tightening. What happens is uh, these type of small cap stocks get beat the worst, and the reason why is because they're borrowing at a higher rate, and the stocks are just burning money. So if you're burning money and you're also borrowing at a high rate, OMG, you can imagine. Um, Let's take a look at SLB. I actually looked at SLB, Raj. I looked at SLB, and it does look good. I saw it on Thursday session. I was thinking if I should share with the team, but I just wasn't sure, to be honest with you. I'm not sure how to feel about this particular stock. I'm just watching it here, observing it to see if it is going to put an end to its downtrend. But yeah, so far the rejection has definitely been visible. Soxel. Um, Okay, Soxel looks quite bullish. I have to say, it does look quite bullish. We got a rally base, and then there's a great chance that we can get another rally. And seeing this particular sector, seeing this particular semiconductor leveraged ETF, it does scare the crap out of me. Not scare me, but it concerns me for trying to short any semiconductor stocks. The reason why I say that is because let's break down some things that are happening here. Okay, let's um, auto range. All right, so let's take a look at the TTM squeeze. It shows that there is undoubtedly a lot of fuel in this particular leveraged ETF, semiconductor bullish ETF. We have volume stacking up ever since we've been accumulating above the 200 SMA line and the 20 EMA line. The 20 EMA line short term momentum gouge is telling us that bulls are closing above the 20 EMA in majority of the consolidation there, and that is a bullish signal. So I think this particular stock is going to eat time off the clock, but long term it looks very bullish, and I think it's bound to head towards 41 in the upcoming months. So definitely keep your eyes out on this particular leveraged ETF. We have broken that downtrend, and so far we're consolidating, eating time off the clock. And when the bulls begin to overwhelm the bears again, once newer buyers are exchanging hands with older buyers, older profit takers here, then this can see a reset and then another base rally towards the 40s there, which is the main resistance level. So overall, I think Soxel is turning bullish on the longer picture, but it is crucial that we absorb this particular rate cut event, and then we'll decide after. Okay, team? So, sorry, rate decision event. So, heading into September 17th, it's going to be very important that you pay attention to what happens, how the market reacts to that when it's released, and how it's going to end up closing. Pretty much, really, honestly. So how it'll end up closing, what the sentiment is going to be, and how sentiment is going to follow up heading into the next session. That's going to be very important, you guys. But yeah, that's really about it for me. There's not much else to discuss. Um, Let's see, take a look at a few other stocks. AI, don't buy anything short term on this one, Jose. Don't buy any short term call options. Absolutely not. If you do buy AI because it's a company that you have been watching for a while and you feel like it's cheap to buy, then make sure you either buy shares or you buy call options at more than a year out leap calls, and you do not buy short term call options. Team, for those of you that are in here, let's talk about this. Okay, there's 46 of us in here, so I really do want you to take this into account. This is a strategy that has helped me tremendously, and if you guys don't know that, or if you guys haven't noticed, you can go ahead and put all of our trade alerts and whatever into ChatGPT and really calculate to see the differences between the last 2 years and this year. So you've really seen a lot of changes. The type of trades that we used to send out is different, and I'm going to show you what's so different about them, what kind of trades I ended up avoiding, or what kind of setups I ended up avoiding, and how that greatly helped me increase my probabilities of the alerts for the team. So I'm going to start off with this chart right here. So if we're if the 20 EMA line is below the 200 SMA line and the candles are trading below it on the daily time frame or the weekly time frame, I do not buy short-term call options. If I just do that, right? And the beauty is, if I don't buy short-term call options here, it kills that FOMO. It kills that, oh, I want to make a lot of money here. I'm going to go short expiration. It's going to have 2 to 3 candles and I'm going to make a lot. The problem is, it just won't happen. And it's an illusion. Like, for example, a lot of traders that bought at 22, you can see they got bamboozled or whatever that term is. And the stock sold off from 23 all the way down to 15. So you gotta be avoiding these type of setups, and it's very, very easy. If you use my system, the 200 SMA line and the 20 EMA, when we are below the 200 SMA and we're below the 20 EMA line, you do not buy a short-term call option. I promise you, if you just do this, that tremendously boosts your probabilities, your winning trade success probabilities. I mean, oh my God, extraordinarily, you guys. So definitely keep that in mind. And you can take that same understanding to the 5 minute and the 2 minute time frame when you're intraday trading. If you're below the 200 SMA line, if price is below the 200 SMA line and below the 20 EMA, you avoid the crap out of it. Now, I want to show you an example of uh, how this thought process, how this change of strategy in the last year and a half directly saved our team, saved me from causing losses to our team because I took that into consideration. Let me show you. So right here, when the market came down to this particular support level right here, team, you see that support level? The old me would have bought calls right here, right here, okay? Not only would I have bought calls at those demand candles, those wick showing, or demand showing through those wicks, uh, that would have tricked me into those trades on that 5 minute intraday time frame. Even if I look at the 2 minute time frame, that would have sucked me into a bullet trade and I would have been absolutely screwed. But you know what kept me out, team? Because we're below the 200 SMA line on the 5 minute time frame and we're below the 20 EMA line, I said, screw that. I'm not going to take the first demand level there. I said, since we got the first rebound there and that broke down really hard, I'm not going to buy this one because we're below the 20 EMA line. And if I put it to the bigger picture, yes, on the daily time frame, we are above the 20 EMA, but the problem is we are so far above the 20 email line that you get what I mean, right? It's obvious universal laws of supply and demand. When we're very, very high up, you're not going to see much demand. The supply is going to be overwhelming, and that is a natural universal law. So yeah, I kept us out of that trade, and that worked out really, really well. I didn't alert that AVGO call, and I felt absolutely amazing. And I said, you know what? This is what I love. This having a system that I can depend on that can just emotionally control me, not emotionally control me, but sort of deprive me of those emotions to not make an emotional decision. So if we're above the 20 EMA line, as we saw on that day, then I just traded. I traded because I know that the momentum is there that day. And once it gets above the 20 EMA, the battle is very, very easy. You're going to make easy profits. So instead of trading a stock like AVGO, you could have been looking at a stock like Tesla that was grinding above its 20 EMA line. And take a look at how beautiful this is, you guys. Above the 20 EMA, even when you get the pullback and bull step in, that gives you another nice run up, even if you miss that, because you're trading based off of this high probability setup where you're simplifying it visually above the 200 SMA line, above the 20 EMA. I'm going to take that bullish trade there, and that's exactly what I did for you on that day. If you guys remember when we made $1,000 in just no time, in just 20 minutes, this is why. This is how it happened. I bought right here, and it just shot up, and we made some beautiful profits there. So if you go to the 2 minute time frame, let's say you're an intraday trader, just look at this absolute beauty. Whenever you get back above the 20 EMA line, bulls are holding really well. You're expecting an expansion. Don't get me wrong. On this day, this particular day, because it was the first day of the expansion, the stock didn't do as you see what I'm saying, right? Like it didn't maintain very well. It still got those sell-offs that you would see, and this explains a little bit of uncertainty remaining. Now let's go to the next day. If you go to the next day, the market was a lot stronger and just overall more bullish. I think I may have been looking at the same day, but you guys get my point, right? You avoid the stocks that are below the 20 EMA. You don't trade those type of stocks. You go with the momentum of the given stocks, depending on what kind of market we're in. So, given that we're in an uptrending market, don't waste your time shorting. You can still make profit. Don't get me wrong. You can look at stocks like Oracle and let's go to Oracle there. If you traded Oracle below its 20 EMA line at the supply breakdowns, every time you banked on this particular stock. And the very next day, same thing happened. You absolutely banked on this particular stock. So it's very simple. If you're above the 200 SMA line and the 20 EMA line is above the 200 SMA line, then you are trading on the bullish side. Okay, you're trading with the bullish momentum, as we can see. The 200 SMA line is sloping up. The 20 EMA line is printing those bullish engulfing candles. You enter right here on the intraday. You're making some really nice profit. You get out of the trade. Keep it very simple, and this is going to greatly help you. So I can show you on the S&P 500 as well. You see the 200 SMA line is sloping up, right, team? We get back above the 20 EMA line, and right here you got a beautiful trade. And this is happening on the 2 minute time frame. So within about 6-8 minutes, you're out with some really great profit. And when you take into account like other strategies, if you go to your supply zone, this is a 1 minute supply zone. So obviously when you get right here as a 1 minute trader trading the 1 minute time frame, then you would get out right at that supply zone. And even the 2 minute traders saw that as a supply zone, but they did absorb it pretty quickly. So yeah, that's the strategy is very simple, and if you just take that into account, whether you're choosing it for your long-term swing trades on the daily time frame, the weekly time frame, the monthly time frame, and you put that into use on the intraday, on the scalping, on the, let's say, short-term overnight swing trading, it's going to greatly help you. So that was it, very simplified, and just using that understanding, I have saved myself tremendously from choosing stocks that are just really bad, that keep going down, and they're just not doing well. Like you see the entire market going up, and those stocks just continue to go down. I'll show you an example. If you take a look at Lulu here, Lulu has been declining and declining and declining, and it's just on a decline. So a stock like that, if anybody bought short-term call options, right? Imagine buying short-term call options right here. Let's not even say right here, okay? Let's say you bought it right here. If you bought it right there, you got absolutely screwed. You averaged down right there, you screwed yourself up even more. If you bought short-term call options there and you got greedy and you didn't secure profits around here, then you got absolutely screwed, and that's basically done. There's absolutely no recovery. But if you buy, let's say, a year and a half out because the stock is already in a downtrend, your insurance is that time. It's not even, um, I mean, I don't know what to really term it. It's sort of like farming, okay? Um, Maybe one crop or a few crops are going to go bad, but the rest are going to do really well when you continue to employ this particular strategy. I had a talk with one of our teammates over the weekend, and they said that 7 months ago they didn't do so good on our trades, and they stopped taking our trades. And the argument that I brought up to the trade is because I know the trader loves to average down. And I said, the thing is, you are averaging down on your losers and you're not averaging down on your winners. When a trade is a winner, you just sort of, you either secure profit or, you let it run. You don't really average down, or you don't add to the position. And I think the thought process should be the same for your long positions. Okay, team, you do not average down. I mean, it depends, okay? If you are dollar cost averaging, that is great. I'm talking about the positions where, let's say you're buying Lulu right here and Lulu continues going down, you're not going to average down on that position. It's just not ideal to do that. By the way, I'm referring to call options, okay, team? So let's say Target is going down, right? Target, the reason why Target's been doing so bad, as you guys can see, it's because it's been below the 200 SMA line and it's just not been able to maintain a nice trend above its 20 EMA. And remember, it's not just maintaining a trend above the 20 EMA that matters. It's breaking structure, okay? Maintaining it and then breaking a structure, it's all about that. If Target had broken structure right here based off of some good catalyst from earnings or any good company catalyst, it would have ended, it would have broken that structure, which is the math of the market, and it would have changed the supply and demand dynamics. So, um, if you guys aren't aware, AI, they're not like humans. They don't have a thought, thought process of sort of anticipating ahead of time. I mean, they are anticipating ahead of time, but the way that it's done is off of numbers, okay, off of market structure, which is the math behind the market. If it breaks that structure, then if you're a short trader, then that's where your short covering comes in. If you're, let's say, a long trader, and they fail to break that structure, then that is concerning for you because it tells you that they're going to continue to decline and the trend is going to continue to print lower lows. Now, what would I like to see on this particular stock? I would like to see equal lows right here and then bulls coming back up above 108. That is the only time you're going to touch target and you're going to add position for the long term. So if you're a trader that, let's say, we're trading it around here and your long position basically came back down to red, then hopefully this gives you an example of what kind of trades are going to fail and what kind of trades, I'm talking about the long-term call options, that are going to do well. So you want to take in, the strategy is very easy. Everyone can do it. You want to take in the consideration that the stocks are moats, okay? They have advantages. The companies have advantages that are always going to put them in demand. That's the first thing. So if you find those opportunities down here, and like I said, even then, you will never buy short-term call options if you're trading below the 200 SMA line and you're trading below the 20 EMA line. You never buy short-term call options, okay, team? You don't even think about that. The only thing that you do in these opportunities is buy for the long term. You farm your contract for the long term. Here's what you do. When you trade around here, you may buy a contract 2 years out, and perhaps it's far out of the money. The strike is 120, and you're buying, let's say, 2027. So let's go to Target real quick. If I were to trade this particular stock, I'd be looking at the December calls. I would say the 130 call. It doesn't have a lot of volume right now. I think the January 15 will have it. Wow, this stock just does not have a lot of volume. Um, I mean, 3,500 is not bad. 2,000 is not bad. But you see what I'm saying, right, team? You're going to pick up January 15, 2027, and you'll buy a 120 call. Now, the beauty is when the stock does, let's say, create that higher low structure and comes back up and breaks the structure and whatnot, it starts to gain premiums really, really fast. And your contracts will start printing 500 to 1,000, 1,500%, where you could turn $250, like you're farming $250 into like $4,000. So this is why I call it farming. Now the beauty with this strategy, or sorry, not the beauty, the one thing that really changes the odds in your favor is if you do not average down. Okay, you do not average down on your failing trades. You let them go, you move on to the next trade, and every single day there's going to be another stock that'll ride the momentum higher where we can just trade it. For example, this is Tesla, okay? We talked about Tesla. We said it was above the 200 SMA line and it was eating time off the clock at that level of resistance, and it was going to head towards 366 resistance. You can see that that happened really well because, as I said, we're above the 200, we're above the 20 EMA line. The stock is in strong demand, and it's just going to be very favored to get that upside. I hope that makes sense to you guys. This is another one, MU. And as we can see, when you get that nice bullish demand reaction right at the 20 EMA line and you're above the 200 SMA, you're above the 20 EMA, this tells you the stock is going to move into what is known as the expansion phase. So the market moves in, like I said, we got two waves, okay? We got the corrective wave and then the expansion, and that is the expansion. If you're in an uptrending market, then the corrective wave is the smaller wave that'll pull back, and the impulsive wave is going to be the larger wave. But yeah, this is what you want to do, team. You don't want to buy stocks that are in downtrends. You want to buy them when they're above their 200 SMA line, and it's like that. Okay, you're seeing those smaller candles at the 20 EMA, and once you get the right reaction, you're going to enter, and you're going to expect further expansion to come in. But if you're in a downtrend, take a look at ALB. Like imagine a trader trading ALB, right, team? While the entire market's going up, this particular stock is rejecting its 20 EMA line and continues to make lower lows, comes back to the 20 EMA, and then goes back. So do you see why buying short-term call options is such a bad thing to do on stocks that are in this type of trend? It's horrible. It doesn't matter what stock you're trading at, team. It can be Nvidia. If Nvidia is in that cycle where it's trading below its 20 EMA line, even if it's the best stock, you're gonna lose money on your short-term call options. So, like I said, if you just take that out of your trading, you add this formula where you say, you know what, I do not buy call options, short term call options when we're below the 20 EMA line, below the 220 EMA. Oh my gosh, this will greatly increase your strategies. And team, this is how I send out alerts for our team. I look at stocks, I'm like, okay, they're above their 200 SMA line, they're above their 20 EMA line. This particular stock is going to go on its expansion. And they go on their expansion because if they show up on your scanner being above their 20 EMA momentum gouge, above their 200 SMA line, it tells you that the stock internals are also in line, or let's just put it this way, institutional inflow is in line with what we are visually seeing here, the feedback that we're getting. So I love that, and I swear to God, team, ever since I have applied this understanding, I've done really, really well for the alerts I send out for the team, for my own trades, and I hope you take this into consideration, and it really puts you ahead in your own particular strategy that you really employ on a day-to-day, week-to-week, or month-to-month basis. I even use this for the bigger time frames, like for the monthlies and weeklies and whatnot. And you can see very, very well when we have this rally, and then we get this base formation there happening above the 20 EMA line. You know that's going to head towards that resistance level up ahead. So it's just such a great strategy. When you find it on the weekly time frame, it's even better because when you find setups, when you find large corrections like this right at the 20, right at the 200 SMA line, it tells you that the trend on that bigger time frame, on the much larger time frame, is resetting. And when any stock that's really good for the future, that has, strong moats, or maybe affected perhaps that year, maybe they made a mistake like UNH, where they had some non or they had some sort of model that was losing them profits. And if you have something like that and your stock goes on a major correction, you look at it on the 200 uh, sorry, you look at it on the weekly chart, on the 200, and you see how close it is to the 200 SMA line. So if you see it coming back here, reacting to the 200 SMA line, and then regaining the 20 EMA on the weekly time frame, oh man, you got a beautiful setup there. And your target for the future can be the recent highs and more upside after that. Team, I do want to say this is not backed by, like, this is not some after the fact. If we go back to history, and I show you some of these stocks. I want to take you to Google real quick. I use that same understanding on a Google analysis. Um, I think it was a long time ago. I made a YouTube video on it, but it really showcases that strategy. And this is Ion Q, by the way. We were talking about Ion Q earlier, and that cup and handle is now starting to rip up. This is HD. Now HD, it retested its 200 SMA line, as we can see on the weekly chart, same time frame that I'm showing you guys, so that you can learn how to apply this yourself. You see, we got a strong demand after the 200 SMA line there. We defended that. The smart money came in and defended it. And the analysis is right here. You can see the weekly chart. And if we take a look at HD, and keep in mind, team, that's the same understanding I'm telling you on this weekly chart strategy. You can see when they came, tested the 200 SMA line, printed the type of candles that we're looking for, the stock did really well. And you can see, I mean, it's back up to its highs there. So really great strategy. Same with Goog. I remember sharing Goog around here, and sorry, around here actually. I made a YouTube video around here, and just look at it, you guys. It's doing really, really well. Um, or sorry, I think it might have been around here. I shared it somewhere around here. But yeah, comes back to the 200 SMA line, and you can see this is where institutions loaded up, and it went from 140, 156 all the way to 242. Why was this stock such a great buy? Because, like I said, it's a stock uh, that that's good for the future. It has its own advantages over the other tech stocks, and like I said, with stocks that are showing, the moat, they're competitively advantaged stocks. You're going to buy these opportunities at the 200 SMA line, on the weekly charts, on those nice demand candles, and expect these beautiful returns to come in. So this is where you pick up some shares. You do what you got to do, the way that you continue to add to your long-term portfolios for your children, and you just let the stocks be. You don't do anything. You don't sell it if something. You just pretty much wait it out from there. And I think it's going to do you really well, as shown here and as shown there. Like I said, you don't have to predict and say, okay, I'm going to buy in on this candle there. You can, if you would like, you can wait for the right candle to formulate. As we can see, that was a bullish engulfing candle there, and they never really broke that. When we did get back close to the lows there, the candles got very small, telling us that supply is diminishing, and then we get this reaction, this strong bullish engulfing, that demand reaction there above the 20 EMA. This tells you with strong reinforcement that we're going to see a new uptrend in motion. So I do want to show you some stocks. Actually, one stock that I noticed, this I was supposed to share with the team, but I almost forgot. ABT here is breaking. Now this one is on the daily time frame, not the weekly time frame. It's on the daily time frame, but we're getting that downtrend breakout. And what this means is, heading into this week, if bulls hold above 133, this stock is going to create a new uptrend and head towards its highs at 141. But yeah, team, this is a strategy that I really wanted to share with you, and I hope it does greatly benefit the way that you look at these type of stocks. My strategy is very simple. I just go through my watch list. I look for two things. Okay, my scanner is. I mean, oh my gosh, team! If you just have this right, percentage change. If you just have percentage change on your scanner, you are set, absolutely set. No matter what list of stocks you have, you're going to see which stock is front running with the momentum where you can trade with that momentum. So you see WBD, right? WBD showed up on my scanner. On Thursday session, and this is the stock that we made so much profit on, you guys. So that trade that I sent out in the body's risky trade alerts, let's go to WBD. This WBD trade right there at 11:41 a.m. Let's take a look at it. This was on 9/11 at 11. So right here, you see right here, once we held that level of support, team, we came back, right? We broke out, we broke the resistance, and then we came back down to test it, back test it. This is where I picked up the calls, and this is where we sold our calls the very next day. So same strategy. You see how we went with the momentum there? Very, very simple. So obviously, I'm not going to chase it when we're very far away from the 20 EMA line. You want it to pull back, but that's how you want to trade, okay, team? You don't just want to trade any sort of stocks. You want to trade stocks that specifically show this momentum. This is another one, Tesla. This is why I was trading Tesla for our team over the last 2 days there. You can see we got in at 10:21 a.m. and by 10:42 a.m. we had already made $1,000 on that stock there, and it was the same way. I look at their 20 EMA line on the daily time frame. We're above the 200 SMA, above the 20 EMA. We are printing the right candle. We're breaking that level of resistance. This is where I'm going to get the team in so that I can participate on that breakout there. And the fact that we got this particular resistance right here, maybe even a breakout, as we can see on that candle there. So it just really simplifies things. And yeah, it's really great. It's really great, you guys. And so you're gonna ask me, right? How come your scanner didn't find? How come you didn't have anything for us to share? Let's go to over my scanner and let's take a look, team. Would you buy this one? Absolutely no, right? Why? We're above the 200 SMA line, but we're in a downtrend. Sorry, the stock, the trend is still sloping down, and we're below the 20 EMA. So that, why should I go against the momentum of that trade there? I would not take it. I would want the easy, overwhelming ones. And now this one right here, team, would you buy this setup right here? Would you trade this particular setup going into Monday's session? Anybody? 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 Would you trade this particular setup here? No, because it has a big wick. Okay, that's a that's a great observation. That is really a great observation. And honestly, I would share your concern as well because the wick seems to be more than a 50% retracement, basically giving back more than 50% of the gains. Now, I do have exceptions if it's a Friday. If it's a Friday, then I still see that as a buy opportunity. But very, very great observation there. Possibly, but hasn't made higher highs yet. Okay, that's a great observation as well. Now, this is why This is why I would trade this, okay, you guys? This is why I would trade this particular one. What do you notice about the pullback? What do you notice about the corrective wave pullback that we had after that massive expansion there? If you notice, we got this liquidity candle. Team, I want you to pay attention to these things. We've talked about it in the mentorship. This is a liquidity candle right there. That changes so much because you go back down, you retest that smart money demand zone right there, right? You got that smart money zone and you retest that smart money demand zone, you print that reversal candle, and you come back up above the 20 EMA. I take that as a very bullish signal. Now, here's what you want to do, okay? You want to draw that trend line there where you have the data points, and once they get above it tomorrow, you're going to trade it. You're going to trade this particular stock with a call option 6 months out. And if this is a downtrend breakout, the same way that you saw right here, this is going to trigger another expansion for a new higher high, and you're going to benefit greatly from that move right there. So, hopefully that helped. Let's go to another one. So, to answer your question, I probably would take this trade, but like Christopher said, I mean, although I wouldn't have traded it above, okay, he said needs to close above 75. Yeah, that's great. That's exactly what I was going for. So, as Christopher said, above 75, I would take that trade 100%. Above 75. So if you really wanted to stick with the high probability A quality setups, you would want it to break that structure at 75 mathematically, which would guarantee that breakout above 77 and then expansion towards the 80s.